So, ladies and gentlemen, welcome. Thank you for joining today's webinar. My name is Paul Cam, and I'm a client advisor here at Oreana Private Wealth. Oreana is a wealth management firm with a presence in Australia, Hong Kong, and soon Singapore, and under $5 billion under advice within the region. Sustaining returns for the future. So sharing a personal painful experience. I still have a NASDAQ QQQ short that I put in first in June and then July last year that I'm still hanging on to and it hurts because emotionally I feel what's happened in the last 6 to 8 months has been so surreal. We're experiencing so much exuberance. So SPACs raising record funding, TME, again, overnight, keeping us on our collective toes. How do we keep a cool head? At least for the parts of our portfolios that we set aside for steady long-term growth. Now, when we did our January webinar, there were many dark clouds when it came to the coronavirus and its grips over us. I'm pleased to report, as Israel is the talk of the town in terms of vaccination effectiveness, things seem like they're easing off globally. And we're starting to look beyond the write-off of the year that was 2020, at least it was for me personally. So the medium-term outlook is a cornerstone of our annual content calendar. For those of you who are new to our process, it's an annual sharing where we update our 5-year outlook and we share the findings both with our wealth management firm clients, as well as our individual client investor base to make sure that they get a line of sight typically afforded to sovereign wealth funds and pension funds. Now, without further ado, let me get into today's events. Agnes, can you please go to the slide with the investment team? So I quickly want to introduce our investment team. We have a team of 4, each with their complementary strengths, and work together in formulating our medium-term outlook. Led by Dr. Isaac Poole, who's speaking today, he focuses on the economic outlook, as well as the macro asset allocation picture. On the manager selection side, we have Shane Hawke, who brings with us 20 years of experience in investment research and advice. Keeping us on our toes, or at least me on my toes, we have Louise and Florence as investment strategists who are both sharp young minds and, insider information, I feel complementary personalities. For those of you who know Australia, I'm given to understand that PAS now has expanded to an office a stone's throw away from Circular Quay. And I know I'm as keen as beans to be able to head back to Australia and just soak in the vibes, having been away for almost 3 years, and a visit is definitely on my radar. So Agnes, the housekeeping slide, please. So a couple of points just before Isaac goes. For every webinar we try to run, we try to keep it as interactive as possible. While Isaac shares his wisdom, I'm actively monitoring and available on chat, so feel free to direct message me. If there's a pertinent point that you'd like to raise, I will, within reason of course, try to weave them in and hopefully add value to the overall discussion. The Q&A function is also a more public way to do it. Basically, whatever method you're comfortable with, we will do our best to accommodate. So without team effort part put away, ladies and gentlemen, allow me to present Dr. Isaac Poole.
Great. Thanks, Paul. Thanks for the intro, and thanks everybody for joining us today. I understand that we've got a really full webinar, so that's great because today the plan is to take you through our all-important 2021 medium-term global outlook. And right, the medium-term outlook that we put together, it's a little different to what you'd normally get from a bank or a wealth manager, because we're not just giving you an annual outlook. We don't really write about what's going to happen over the next 6 months. We don't write what's going to happen over the next 12 months. We deliberately focus on the next 5 years. And we do that because we think that's the way to build a really clear roadmap and a really clear set of recommendations that we think will help protect on the downside, but also deliver returns on the upside and deliver that over the medium term without getting too hung up about very near-term volatility. This is my 3rd medium-term outlook with Oreana, and we've had a lot of great input from the team. So hopefully over the course of the next 40 minutes or so, you get some useful insights and some understanding of how we're seeing the world. But before I start sharing you my thoughts and our views, I'd like to get some thoughts and views from all of you. So if I could ask Agnes to put up a poll. Hopefully everyone can see the poll here. What we're asking is, what are the 3 key themes that are going to shape the investment landscape over the next 5 years? What do you think is going to be really critical in driving returns, driving risk, driving outcomes? Is it sustainable in ESG investing? Cryptocurrency is a big topic at the moment. The growth of China, low interest rates, they're very low. A lot of talk about commodities at the moment, and copper and gold and silver, and how that's driving a super cycle. Working from home, we've all had some experience doing that over the last year or so. EVs, electric vehicles, Tesla, Elon Musk, is that critical, or the aging population perhaps, or something completely different? So have a go at selecting a few of those. Let us know your thoughts. And while you're doing that, we will begin to kick off on our medium-term outlook. But before I get to the medium-term outlook, even before again, what I think is important is to just reflect a little bit on where we've come from, provide some context for all of this. And so if we can, I guess, if we can exit the poll now. Thank you, Agnes. We'll get to the answers for that later on. But right now, let's take a look at what happened in 2020, and we all lived through it. So I'm not going to dwell too much on the economics. I'm not going to dwell too much on the market movements. But it's sufficient, I think, to say that 2020 was a uniquely unusual year for economics. We had the global COVID-19 pandemic. That basically was the catalyst for a sharp and very brief and very painful recession globally. That recession was punctuated by widespread lockdowns, which we all experienced, by social distancing, which we all experienced. There was a collapse in the service sector that was very, very painful, and a sudden stop in economic activity globally. As a result, equity markets collapsed and credit markets seized up. And if we flash back 12 months, this time last year, it was a pretty terrifying place to be working in financial markets. We had limit downs across equity markets globally. It was a very challenging time. And it was fortunate that the Fed and other central banks stepped in with aggressive monetary policy. And that monetary policy and the support that they provided, and the support that governments provided in terms of unprecedented fiscal stimulus, and the largest and most coordinated level of fiscal support that we will have seen in our careers, really was the catalyst for stopping that recession and stopping that pandemic from moving out of the financial markets and into being a full-blown credit and financial market crisis. And in our view, it was that support that allowed financial markets from April onwards to start functioning normally again, and for us all to be able to get a bit of comfort about how markets were going to move over the next 12 months, the next 2 years, and the next 5 years. Towards the back end of last year, as we're all aware now, we had optimism about a vaccine. There was some clear signs that we were about to have the fastest development of a vaccine in history. That, of course, happened. We had emergency approvals in the US and the UK, down here in Australia, where I am. And that started to be rolled out in December in parts of the world, and now in Q1 in 2021. So a lot went on during the year, lots to grapple with, lots to deal with. We ended the year with a near record loss in economic activity over any 12-month period. It was challenging. This was a pretty difficult time for the economy and for investors. So that's the context. I mean, from our perspective, as I said, this is our third medium-term outlook. Last year, we released our 2020 medium-term global outlook that very clearly focused on reviewing resilience in portfolios so that you could reduce surprises. And that was critical for us because we wrote this paper, we released this document before the COVID-19 became a pandemic, before it was widely known around the world as a major global risk. And while we certainly didn't expect a pandemic in any way, shape, or form, we were expecting a recession and we were concerned about a recession. So our medium-term outlook last year really did provide us a great roadmap for improving resilience. And the recommendations we made in that medium-term outlook back at the start of 2020 were part of an incredibly important roadmap for us that really helped us successfully navigate and negotiate some of those challenges in 2020, and importantly, provided us an opportunity to deliver on our commitment to give great returns to our clients. So, what were those that roadmap? What was it made up of? Again, this document looks out over 5 years. We made 10 recommendations across 4 key areas that we thought would be transformative over a 5-year period, and would be really critical over that 5-year period to help protect returns and deliver great returns. I'm not intending to go through each of these in detail because I summarize them here on the page. You can see them there. You'll see a summary of them again in the 2021 medium-term outlook, which you're all going to receive via email. And you know that'll have it there in black and white. But I will make the following points about those roadmaps. We really achieved success last year, not because we guessed that there would be a recession or that we guessed that equity markets would collapse and then recover. We did it because we had a playbook that set out the actions we could take if those things happened over the next 5 years. Now, as it turns out, those events all happened in the space of about 6 months. But instead of having to race around trying to build a response to that, we had the playbook ready. We were able to take actions that were necessary to help build resilience and protect on the downside, and then be able to participate in the upside when it came. And that's really the hallmark of resilience for us. That's the importance of these medium-term outlooks. They let us respond very quickly to events that might happen. They let us identify the actions we should take to deliver great returns. And importantly, when and if there are negative outcomes, that resilience leaves us with a really solid capital base to be able to grow returns again when the upside happens. So this was important for us. And the 4 boxes here just show what some of those actions were that we took and what the playbook consisted of, because these are still important. You can go back and read this document now. It'll give you a great set of recommendations and actions that you could take to build a great portfolio. And they include: have great portfolio diversification. Think about the assets that you want exposure to. Know the risks that your portfolio might face in any given scenario. Know how you're going to respond if there's a sudden change in events. Be dynamic where you can. So be willing to buy riskier assets when valuations become more accommodative. Know exactly how you're going to respond in that situation so that you don't miss opportunities to gain wealth over the next 5 years. And carefully select managers and carefully select your exposures that are going to help protect on the downside, but also help you participate in the upside. And these 4 themes, if you like, these 4 areas and the 10 underlying actions were the key elements of our roadmap in 2020. They helped deliver resilience, and importantly, they helped us really deliver good outcomes for our clients. And I'm not going to dwell on performance too much, because obviously performance can be fleeting. I don't want to say that it was easy to do all of this, because that's easy to say in hindsight. It was challenging, and we really did rely on our medium-term outlook. But in a terrible time for investors in February and March, when global equity markets were down 35% peak to trough, and global credit markets were down 15% peak to trough, and liquidity was drying up, and there was no way of selling anything at a reasonable price, we found ourselves ready to respond and able to protect on the downside. And in a month like March, where equity markets were down 15% in 2020, we were able to protect on the downside with our portfolios being down less than 5%. And even though there was nowhere to hide, we knew the actions we would take. We followed our recommendations, and that helped us deliver good returns for our clients over 2020. And on this page, what you can see is the results for our active alpha growth portfolio here in Hong Kong. It was a good year. We were able to be dynamic. We constantly used our scenario analysis. We constantly were in touch with our managers to make sure that they were helping to protect on the downside, and it helped us to deliver returns of greater than 17% over the calendar year, shown on the left-hand chart. Very solid returns over the entire year, and strong performance since inception relative to any of our peers. And that's shown on the right-hand chart there, the little green triangle, which represents our active alpha portfolios. It's up in the top left-hand corner, which is where you want to be. Higher returns, lower risk. And a lot of that is attributable to the clear roadmap that we set out in the medium-term outlook. So now we go to 2021, and it's time to look at our new 2020, our new medium-term global outlook, and what that means. How are we going to respond to the next 5 years? We've delivered on our promise for resilience. We've moved past a global recession, and it's critical in our view, to have a set of actions that will help us sustain those returns over the next 5 years. And for us, again, we do that by identifying 5 key themes that we think are going to be critical over the medium term. And here they are. I'm going to, as I talk through these, I'm going to see if Agnes is able to put up the results of our survey for everybody to see if any of those were available or selected by you as the audience. So here we have, our 5 themes: the start of a new cycle, use scenarios to manage surprises, searching for yield in a low rate environment, the growth of China, and integrate sustainable investing. We can see here that the growth of China, number one most important topic. So we're aligned there. Sustainable and ESG investing is number 2. So that's great. Another alignment. The aging population and low interest rates for longer, another one. Interesting that cryptocurrency and commodity super cycle not featuring all that heavily, but that's great because it suggests that our viewers are not getting swept away in the latest fads and are looking to really focus on the medium term. So what I'm going to do is run through our list of 5. I'll tell you why we think they're so important, and I'll share how we can help use these themes to drive returns for you here at Oreana Private Wealth or with us at Oreana. So if we can just take that poll results down now, and I'll flick to the first of our themes. The first theme is the start of a new cycle. And just to sort of flesh out what I mean by that, because it's probably not entirely clear just by the name. What I mean is we have just had a bit of a reset. We've come through a recession. We've had some of the most accommodative monetary policy released by global central banks in developed markets and emerging markets that we've ever seen and potentially ever will see. We've seen fiscal stimulus step in and really be supportive of economic growth coming out of the pandemic recession. This, in our view, has put us right back at the start of a new economic cycle. And in our view, this economic cycle will not be exactly the same as the last one that we've experienced. History never repeats, but we think it's going to be very similar because history often rhymes. So in our view, we think we're looking at a cycle of relatively low and contained inflation. It's very important what's going to be driving that, because inflation is the key metric that central banks look at when they're deciding monetary policy. And we think inflation will be contained by low household income growth. We think aging populations are going to naturally drive inflation lower. We think that improved productivity from a technological boom and rapid technological progress is going to help keep inflation contained. And that low inflation is going to allow central banks, the Fed, the Bank of Japan, the Bank of England, the PBOC in China, the RBA in Australia, it's going to allow all of them to leave interest rates and policy rates low for a very long time. Keep that in mind, because I'll touch on that point a little bit later on in one of our other themes. But for now, let me just say that low rates are going to mean that we are in an asset reflationary environment. That means risk and growth assets are likely to perform well. And I'll make 2 points about that. First, we think that that asset reflationary environment and low rate environment is going to mean that equities will perform well over the next 5 years. Now, that's not a signal for everyone to just go out and rush out and buy an ETF and park it there and say, that's great because I'll get the market return. You can and you will. But yeah, as we saw at the back end of last year and throughout last year, you don't always just want the broad index return. There are opportunities to outperform. And we saw that with China, for example. Geographical allocations last year were critical in driving excess performance. We saw Chinese equities over 2020 outperform US equities by around 1,000 basis points. That means that careful asset allocation within the equity space is going to be really important in delivering great returns over the next 5 years. The second point I'll make is that there will be volatility. There always is. There's a 5% drawdown in equity markets roughly once or twice a year. That happens all the time. Get a 10% as frequent as once a year. So in this environment, you're still going to get volatility, and being able to look through near-term volatility and focus on the medium term, that's going to be really important in managing your wealth, in making sure that you grow your wealth through that period and access those strong equity returns. And that is where us as an investment group and your advisor, as the individuals on the line who hopefully invited you along to this, they can be of major assistance. We have a really clear track record in managing geographical exposures. Your advisors are absolutely the right people to talk to when markets get volatile and the going gets tough. And between us, we can help manage those near-term risks and really help to focus on delivering those longer-term performances. Let's go to the second of our themes, which is use scenarios to manage surprises. When I read 1-year outlooks from the large banks and from the fund managers that we invest with as well, I'm always struck by comments that sort of go along the line of the outlook is uncertain, uncertainty is elevated. Yeah, I mean, these statements are true and they're correct. The outlook is uncertain, and uncertainty is always elevated for one reason or another. It's just not a very helpful statement because it's a truism. It's nothing new. We know that. So how do we deal with that instead? Well, we, rather than say it's uncertain, we say we embrace uncertainty. We believe in dealing with it. We think that there's ways to cope with uncertainty and still manage portfolios through it. So we do that by using scenario analysis. And we constantly like to check how our portfolios are performing, how they're performing through our base case, how they might perform through a series of scenarios that could be very bad for the global economy or very good for the global economy. And currently, we've thought about 3 different scenarios, and they're shown here on this slide. So the 3 scenarios we think are quite plausible and will have meaningful and material impacts on our portfolio. 1, an inflationary shock. And that's one where inflation surges in the next 24 years, in the next 24 months, where central banks are forced to hike sooner than they would like. And that's challenging for global growth. The second scenario is a technology boom, where all that technological progress that we've seen rapidly build up over the last year and over the last 5 years helps to drive productivity gains in a very sudden and strong way. And we have a situation where medium-term and long-term potential growth is really supported. And that allows central banks to leave interest rates lower for longer. that allows inflation to remain lower for longer, and economic growth is really strong. And finally, we have a worsening in US-China trade relations, where the economic recovery stalls because global trade weakens, and we have a challenging geopolitical environment between two major superpowers globally. We've seen it before. We're not out of the woods of this scenario yet, and so we think it's really important to keep an eye on, is that something that could impact our portfolios? And we quantitatively check these. How will they impact our portfolios? And you can see here that, in our view, the inflation shock and the China-US trade war are bad for equities. They're bad for growth. They're a challenge to our view. They're a challenge to that start of a new cycle. The tech boom, on the other hand, is a positive outcome. You have positive economic growth and really great returns in equity space. But instead of sort of saying that we're definitely going down the path of one of these or going down the path of the other, we like to say, well, yeah, we're pretty good at forecasting, but we're not infallible, and we know that we're going to be wrong with certainty in some place. So why don't we use these scenarios to carefully manage our portfolio exposures? And we'll continue to do that. We'll continue to do that with all of our portfolios. We report on this in a regular basis, and you'll see the results of that over the course of the next year and over the course of the next 2 years in our regular communications. And if you don't see any of that and you're interested, please reach out to us or reach out to your advisor. So the third theme is searching for yield in a low rate environment. And a couple of slides back, I told you something that you all probably already know. Interest rates are very, very low at the moment. They are lower than they've ever been in my lifetime. They're lower than they've ever been in anybody's lifetime, because up until now, we've never seen a negative interest rate. And now we see that in vast parts of the fixed interest space globally. And the point is that central banks are at pains to say to everybody listening that they intend things to stay that way for some time. That makes it pretty challenging for investors and very challenging for savers. I mean, if you're an investor, you simply cannot any longer just turn to the safety of cash and expect to get some sort of return for your low risk and for that safety. You effectively get zero return for that level of risk. You cannot just rely on cash to protect you anymore and deliver some return. So for savers, time deposits are simply not going to cut it. If we take a look here, and what I've done is just grab the time deposit rate for a major bank in Hong Kong. I won't say which one, but if you grab $100,000, go stick it in a time deposit for 12 months, then in 12 months' time, you're going to have $300 in income. Now, that is not going to let you retire with dignity. It is not going to be a livable income. It is not going to keep up with inflation. You are going to lose money in real terms. The days of having time deposits that deliver you a genuine income are gone. So perhaps you move out to buy some sovereign bonds. Perhaps you buy some investment grade credit. Perhaps you move further out the risk curve and you buy some high yield debt. And I use high yield debt carefully because high yield debt is not what it used to be. You're getting 3%, sometimes lower than 3% on the riskier part of the international credit markets. But all of these are important: sovereign debt, investment grade credit, high yield debt. They can all play a role in the portfolio. We use them with very clear objectives within our portfolios. And we have a range of great managers that help us to provide some income, some return, some downside protection, some tail risk hedging, important parts of the portfolio. But we think over the next 5 years, you're going to have to look elsewhere if you want real income. And for us, in this low yield, low rate, longer world, we think that alternative credit is going to be increasingly important. And alternative credit includes direct lending, it includes bridging finance, it includes housing-related debt, it includes consumer finance. It's a broad space. There's lots of opportunities out there. And these are the areas where we've seen real in interest and loan space, we've seen really real opportunities to gain yield. In some cases, as you can see here, as high as 8%. These tend to have very low historic volatility. Historic volatility does not indicate low volatility in the future, but we have been working with some of these managers for many years now. We've seen them through cycles. We saw them through 2018. We saw them through 2020. We have confidence that, that they can help to deliver income. We use them within our income portfolios. We're confident they can be used to protect on the downside. We use them in our active alpha portfolios, and we have very long experience working with alternative credit in an institutional space, in the retail space, in Hong Kong, in Australia, in Asia, and globally. So more than anything, I think over the next 5 years in this lower for longer environment, this is going to be critical, and these asset classes are going to be really important in helping to manage risk-adjusted returns. And I'll say it again, just to finish off here, the risk-free rate, time deposits, the cash rate is effectively zero or lower pretty much throughout the world. And you cannot really rely on it to provide you with the right sort of protection and some sort of return. So if you're interested in discussing this further, if you're interested in looking at income opportunities, if you're interested in looking at better protection, downside protection, then get in touch with our advisors, get in touch with us as a group, and we can share our very long history in managing these risks and delivering these outcomes. Let's go to the next theme, and I think this is one that everyone on this call, I suspect, is pretty familiar with, given where we sit geographically, and that is the growth of China. China is enormous. It's been impossible to ignore. It has a growing influence in geopolitics. It has a growing influence in global economics. Regionally, it is really starting to gain power and gain influence, and that's flowing from geopolitics and economics now into financial markets. So what I've put on this slide is the 1, 2, 3 of China. So China has many policy levers available to it in the economic sphere, and those policy levers allowed it to be the first economy to exit recession in 2020. And that happened despite the strong and broad lockdowns that China had in place, as it was the first place to enter recession. Now, that was a remarkable recovery. What about number 2? China has the second largest economy globally. Now, a lot of people are aware of that. What everyone may not be aware of is that China also has the second largest equity market globally. It is a serious player in economic terms. It is a serious player in economic capital terms and the flows of economic capital, and it is a serious player in financial and asset market capital moving around the world. But despite number 1 and 2, foreigners own just 3% of China's domestic A share. That is tiny. It compares with foreigners owning 37% of US equity markets. It compares with foreigners owning 12% of Japanese markets. Even markets like Malaysia and India have significantly higher foreign ownership of their domestic equity markets. So somehow, despite China's growing presence and enormous markets, enormous economy, people have ignored the rise of China. But meanwhile, as people have left their exposures to Chinese equities effectively at zero around the world, we've got a situation where China's continued to liberalize its markets. Access is opening at a rapid pace and is now very open to foreigners. We have increasing representation in global bond and equity benchmarks. And as a global investing and financial markets, that's all been sort of ignored over the last 2 or 3 years. And we're left with this situation where there is a structural underexposure to China's equity and bond markets from the rest of the world. That's not the case within our team. We've acknowledged the growth of China. We know about China. We've been covering China's economy and its capital markets for more than a decade, and we believe that China is incredibly important for diversification, and it's incredibly important for alpha. And I mean, just to cover it off, it's a volatile market. You can see here on the chart that annual returns over the past decade have been between -25 and positive 55%. That's a wild ride, but that does show that there are significant alpha opportunities available if you're aware of the market, if you follow it closely. And we've been following it very closely over the last year with an increased allocation to China during 2020. We think it's going to be an increasingly important part of the portfolio process over the next 5 years, and something where if you have an interest in this space, please do come and chat to us about that. Now, to finish off in the last few minutes, integrating sustainable investment. It's our fifth and final theme for the 2021 medium-term global outlook. It is a big, increasingly important topic. It's, we think, going to be one of the major themes over the next 5 years. Sustainable investing includes ESG investing, it includes impact investing, it includes climate change, includes social investing. We know that it's enormous and growing. You can see here on this quote that Deloitte expects ESG-related investments could grow 3 times faster than non-ESG-related assets by 2025, and that would take ESG-mandated assets in the US from $12 trillion in 2018, a 40% increase to $17 trillion in 2020, and we're looking at a more than 100% increase through to 2025 to $35 trillion. This is rapid and remarkable growth. So ignoring sustainable investing is simply not an option for investors. And I'll tell you what, people are not ignoring it. And we are not ignoring it. And I'll tell you why we're not ignoring it. It's because there is loads of research out there that suggests that ESG, sustainable investments can deliver excess returns over the medium to long term. Those excess returns range, the estimates range from 2.3% through to 4.4% per annum. What does that mean? It means if you're ignoring ESG or sustainable investing, you're literally potentially throwing 2.3 to 4.4% away, just giving it up because you're not interested in it. And we think it is really critical to have a view, an understanding, and a process and a philosophy around sustainable investing, and we do. And we can help you understand that, and we're always happy to talk about it. Understanding the benefits of sustainable investing has been part of what we do for several years. Since I joined Oreana, in my roles before that, in the very large pension and the very large sovereign wealth funds and the very large institutional investors, this is a critical part of building portfolios and delivering returns. And we've incorporated that into our portfolios with good success. We'll be sharing a white paper very shortly on our views and thoughts around sustainable investing and what that means for investors. So that will be coming out soon. And if you're interested in that, if it's something that you would like to see more of, if you would like to talk more about it, reach out and speak to our advisors. If you'd like to see where the exposures to this area are, have a chat with them, please call out to us. We think this will be one of the major themes over the next 5 years. So I'm going to finish there. That's our medium-term outlook. There's 5 themes, 14 recommendations for what you can do, what we'll be doing. And if you have questions about it, we'll get to some in a second. If you want to follow up, if you want to know more about our discretionary portfolios, if you want to know more about our approach to sustainable investing, or if you just want to know how we can help grow your wealth, get in touch with us, get in touch with one of the advisors, and we can talk about it. So I'll stop there and pass back to Paul.
Oh, fantastic. Thank you, Isaac. Okay, so we've got a couple of questions here lined up already. If you've got any points that Isaac raised that you'd like to discuss, please don't hesitate to throw them in the Q&A. All right, let me start off. So Pooch had a question. Thoughts on US dollar as a global currency and its current weakness? I also had another question. Maybe I'll incorporate both together. First on the US dollar as a global currency, but also, with those of us with some Australian dollar exposure, is it that the US dollar is getting weaker or the Australian dollar is getting stronger? And what's your comment on those, I guess, the relative forces that drive those currencies? Isaac?
Yeah, good questions. And I'm going to preface it by saying when interest rates are really, really low, as they are now, as they will be over the next 5 years, currency movements are going to have an outsized impact on your portfolio returns. Currencies become the pressure release valve for the central banks in a world where they can't cut rates anymore. So expect to see volatility here. It will be very important to get your hedging right within your portfolio, and you'll see that currency moves are going to drive portfolio returns in a way that they probably haven't since 2010, 11, 12. As to directionally, I mean, the US dollar has been weakening for the best part of the last 18 months, and it's been a really large consensus view that's been driven by very, very low interest rates and falling interest rates in the US, where they were falling faster than European and Japanese and Australian central banks could fall, because there was more interest rate in the US that had further to fall. And so that interest rate differential knocked the US dollar down. Now we're flipping the world around and we're coming to a recovery where the US economy is likely in our view to outperform the rest of the world. But unlike the way that I think a lot of people think about currencies, I don't think that it's economic strength that has anything to do with currencies. The stronger economy doesn't drive the US dollar higher. Typically, it results in a weaker US dollar because capital sees that the US is growing very strong. It assumes that the rest of the world is going to catch a major tailwind from that. And you find that risk currencies, the Aussie dollar, Asian currencies, they tend to do really well in this environment. So from our perspective over the medium term, we think the US dollar is likely to be weak to moderately weaker against the big commodity and risk currencies. It'll be broadly flat to moderately weaker against some of the developed market currencies. And for the Aussie dollar, I'll just say this: we've had a positive view on the Australian dollar for some time, that we continue to think it's going to strengthen, and we think it's going to continue to strengthen because it has a significant tailwind coming out of the recession. We've had a slower recovery in Australia that's gathering speed. We've seen commodities pick up, which they always do during the early parts of a recovery. Interest rates are drifting higher. There's more risk appetite around there, and these are all tailwinds to the Australian dollar.
Great, thank you, Isaac. Question from Gavin: where are we going to see the growth in ESG? Is it primarily in Western markets, US, or also opportunities across Asia, China? That's
such a great question, and where I think you'll see the growth is going to be in Asia. That's for a couple of reasons, not because Asia as a group or as a region cares more about ESG, just because it has further to go along the path towards sustainable investing and sustainable economics. If we flip to Europe, for example, the UK, US is moving along this way as well. ESG and sustainable investing has been an important part of the processes there for some time. It's enshrined in law and regulation for the large pension funds to have a very clear sustainable and ESG investing process. So that will continue, and companies that are based there will have very clear ESG credentials. But what we're seeing is that's starting to trickle down to Asia, and it's being driven by clients and by people who want to invest in greener companies and more sustainable sectors. But it's also being driven by the companies themselves who have realized that those companies that have introduced solid sustainable policies, ESG programs, have had better returns for their shareholders and for their investors. So we'd expect that to start really permeating the Asian region, and there are great opportunities around this part of the world in that sustainable investing space.
All right, great. Okay, Isaac, we've got two more questions on the board. If you could, and we're conscious we're running out of time, so I'll just give them to you both at once. If you could give us a bit of comment. From Michelle, given the drastic political changes in Hong Kong, any concerns around China restrictions of capital money moving out of Hong Kong? And from Sam, will crypto ever form a part of the portfolio given this take up by some major players such as PayPal, Visa? So basically, money moving and value transferring. What's your opinion, Isaac?
Yeah, great questions. I mean, on Hong Kong and China, I think, and we've written about this in the past, I think that it's in the interests of everyone to leave Hong Kong as free and open as you can and to allow free movement of capital, even though there may be other economic restrictions based on Hong Kong. That ability to use Hong Kong as a capital centre is likely to persist. And I think while there are plenty of risks around that, and there are political risks, there are economic risks, there are financial risks to it, in our view, the likely path over the next 5 to 10 years is for a broad status quo to persist. And there may be some capital controls placed on individuals. We've seen that already. But more broadly, it appears that the preference is to allow free movement of capital in and out of Hong Kong at least. Crypto is a different matter. I mean, we can conflate the two a little bit, but crypto is a tough one from a portfolio perspective because it's not really a currency in the truest sense of the word. It has been used as a store of value, although that value has not historically been very steady. So the value or the store of value has gone up and down in a very volatile fashion. And that makes it a challenge to put in a portfolio from a risk perspective. The other challenge is that I don't have a clear framework for valuing cryptos because there's not a stream of income at the moment that I can discount back at any interest rate to sort of get a fair value for it. So putting it into a portfolio from that perspective is a challenge. Now, it's not to say that it will never have a role in the portfolio. It may. That role, I think, in the near to medium term is likely to be small because it will be risk weighted and the risk attached to cryptocurrencies is high. The volatility has been high and that will necessitate a relatively small position. I'd expect that it may take several years before cryptocurrencies take over a role as a real clear store of currency and before they're widely usable to purchase real goods as a currency is. So we're some way off. It doesn't mean it doesn't have a role in the portfolio, just that role should be appropriately risk weighted given the historical volatility we've seen.
Great, and thank you once again, Isaac, for your presentation and your answers to the questions. As usual, if anyone on the call has any further queries, please feel free to direct them to us. From all of us at Oreana, thank you very much for your time and attention today, and have a good day.
Thanks, everybody. Thanks for joining.
Thanks, everyone.